Great to see you here. Welcome to our YouTube channel. My name is Luc de Ceuster. I'm founder of the Ceuster Academy. If you are here for the first time, do not forget to click the subscribe button. Click on the bell so you get a warning every time we have a new video online. In this video, I'm going to continue the example we were talking about in the previous video about the payment of a loan or a mortgage. In that example, we were looking at fixed monthly payments, and now we are going to look at a different example. Now we are going to pay constant capital payments. So every period, we're going to pay an equal amount of the capital. It's a different approach, and you will see that the results are completely different. Now, the fixed capital payments has some advantages, and we will compare the two elements at the end of the video. Of course, there are some disadvantages, but you will see that it may be interesting, and it's always a good way to consider. The monthly payments, instead of having a fixed amount, we are going to take the initial capital and we are going to divide that amount over the number of years we will be looking to pay the mortgage. So for example, you have a mortgage over 20 years, you have a capital of 200,000, so you divide it by 240 periods, which will give you, let's say, the capital amount to pay every month. Now, the schedule, the calculation is a lot easier because the total amount you will have to pay every month is equal to the proportion of the capital plus the interest on the outstanding capital. And the sum of those two will be your monthly payment. In the previous example, we had a fixed monthly payment every month, so which was composed of the major part at the beginning, certainly being the interest, and a small amount of the capital. The capital was increasing, the interest was decreasing. Here we will see that the capital will be reducing or decreasing a lot faster, which also has a positive effect on the interest. Let's look at the first payment. We have the same loan, 150,000, we pay over 30 years, and the interest rate is still 6%. Now, when we considered the fixed monthly payment, we had an interest rate, or we had a fixed monthly payment of $899.33. There was an effective annual rate of 6.17%. That doesn't change. But now we are looking at a different element. Now we have the outstanding $150,000. We have a monthly interest of 0.5%, which is the 6% divided by 12. And what we find for the first month, we have to pay an interest equal to $750. If you still remember the calculations of the previous video, you see that this amount is basically the same. Because at the end of the first period, we didn't pay any capital yet, so there is still $150,000 outstanding. The next element we have to add here is in fact the amount of capital I'm paying. And we looked at 30 years monthly payments, so we have to consider 150,000 divided by 360, which is in fact $417.67. So now we have the interest payment plus the capital payment, which will give us the totality of the amount to pay every month, which is $1,166.67. And this is a lot higher than the fixed payment that we had before. Now, when you are young, it may be difficult to pay these $1,166. And the $899 may be more interesting for you. So this is a choice. At the beginning, your payments will be higher, but we will see in the table that in the following years, the amounts are in fact, or the total amount is reducing a lot faster. Let's have a comparison, period 1 and period 1, let's say with fixed monthly payments, and period 1 with the fixed capital payments. Remember that we have the same outstanding capital at the end of period 1, $150,000. We have to pay the 0.5% interest on that amount, which is $750, and we pay a principal amount of $149. I'm not talking about the dollar cents, but you have the exact numbers on the screen. The other thing is the fixed monthly capital payments. And the fixed monthly capital payments, you see, first of all, at the end of period 1, we have the same outstanding amount of $150,000. We have the interest paid is the same, it's also $750. But now the capital, the amount of capital is 1/360th of the original amount, which is $417. So when we look at the result of the fixed monthly payments, we see that we have a fixed amount to pay of $899, and we reduced the amount of capital from $150,000 to $149,850. So this is the situation with the fixed payment. When we look at the fixed capital payment, we see that our initial payment is a lot higher. It goes from $899 to $1,166. The other thing is that the outstanding capital goes down to $149,583. And that's a remarkable difference compared to the fixed monthly payments. Let's have a look at the second period. What's happening in the second period? Well, the fixed monthly payments, we still have the same fixed amount. The interest to pay is a little bit less because the capital was reduced to $149,950. The principal paid is the $899 minus the interest, which is $149.33, which is a little bit higher. So basically we still pay the $899, but we see that our capital went down a little bit, and we are now at $149,701. Now we will immediately already see a difference when we have the fixed capital payments. The outstanding capital at the end of period 1 was $150,000. Now we have the interest paid, which is the amount, let's say $149,583,033. So this is the new capital at the start of period 2. We see that the interest is $747.92, which is lower than the $749 with the fixed monthly payments, and the principal paid is going down again. Now we see for the monthly payments at period 2, at the end of period 2, we have still the fixed amount, $899, it didn't change, but we see that the outstanding capital is reduced a little bit. On the other hand, we see for the monthly capital payments that the monthly amount went down a little bit because there was less capital. The amount of capital we're paying is still the $417, and we see that now the outstanding capital becomes equal to $149,165. And when we continue over more periods, we will see that the capital, outstanding capital in the example with the capital payments is going down a lot faster. The interest amount is a lot less, and we see that the initial high payment is going down quite rapidly. What we will see is that at the end there will be a remarkable difference between the two methods. So let's have a look how both methods look alike. Let's now compare both methods, and let's start with a table with the calculations with a fixed monthly capital payment. We see that the capital is decreasing, the interest is decreasing, the principal amount in this case is constant, and the total amount to pay monthly is also going down. When we compare this with the fixed monthly payments, we see that the capital is reducing faster. The interest rate is also, or the interest paid is also going down faster. The principal is constant, where in the method with the fixed amount, it's increasing slowly, but the total amount to be paid is higher, but it's also decreasing. That's one of the advantages and the disadvantages. Now let's look at a table. When we look at it, the total interest paid over the period is 135,000 approximately. Now when we look at the monthly payments, where we have an average monthly payment of 899 in the fixed payment method, we see that the average monthly payment goes down to $792. So this is already a very important advantage. But we can also look at the total interest paid and the total amount paid, where we see that the interest is about $40,000 less than in the previous period, which means that the total payment goes from $323,757 to $285,375. So there is a clear difference between the two methods. All depends on the possibilities that you have. Can you pay the higher amount at the beginning or not? This is a decision you have to make, and you have to consider that related to your own possibilities. These were, again, some interesting facts about mortgage payments, a different method. So now you know two different methods how to calculate and evaluate mortgages. There are more videos to come. If you're here for the first time, do not forget to subscribe. Click the bell button so whenever we post a new video, you will get a message from YouTube saying that there is something new available for you. I'm looking forward to seeing you here again. Thank you and bye-bye.